Stockbrokers, investment advisors, and some investors may have found themselves thinking about the old disaster movie Earthquake last month. Volatility shook the stock market throughout October, with the VIX, the Volatility Index, or otherwise known as the Fear Index, spiking nearly 80%. This year has seen a major return in market volatility after an unusually calm 2017. So the questions become, are these just isolated tremors or a preview of the next major disaster? It's time once again to tune out the hype and focus on the facts. Facts that matter to you, the income generation. Let's get started. Get ready to separate reality from myth.
With us, David Scranton.
David Scranton.
David Scranton.
David Scranton.
But David Scranton says, hey, not so fast.
How does it affect the markets? How does it affect the economy? Thanks to efficiencies in new technology and a staff of veteran analysts and portfolio managers, Sound Income Strategies strives to set new standards and bring institutional style investing to your portfolio. I'm David Scranton. Amid growing concerns about the global economy, the Dow Jones Industrial Average tumbled more than 800 points on October 10th, marking the third largest one-day point decline in stock market history. After a relatively quiet summer, the return of extreme volatility last month confirmed that Wall Street is absolutely no longer capable of ignoring economic realities forever. Some of the same concerns that caused record volatility last winter and going into the spring have been shaking the markets again this fall. Is the volatility we're seeing now just part of a market's natural ebb and flow, or is it the precursor to the next major correction? That's an extremely important question for members of the income generation, those of us over the age of 50. So we're going to get right to the bottom of it on today's show. And joining us will be renowned economics expert Peter Morici and financial advisor Greg Melia. But first, let's look at how market volatility is measured and what's behind all the unsteadiness that we've seen so far this year. Yes, volatility is, to a certain extent, a natural part of the stock market. The market's constantly in the state of flux, and sometimes those shifts are quick and extreme. And, as I often point out, the bond market also experience constant ups and downs also. They're just generally not as rapid or as dramatic as the stock markets. But sometimes the stock market will go through periods where volatility goes beyond the norm. And that's really what we've seen at this point recently in 2018. Consider this. We already mentioned that the Dow's 831-point drop on October 10th marked the third largest single-day point decline in history. Well, can you guess when the single largest decline occurred? That was just 6 months ago on February 5th, when the Dow dropped nearly 1,200 points. As a matter of fact, 5 of the 10 largest single-day point declines in the Dow's 122-year history have occurred, you guessed it, this year in 2018. And the year is not even over. Meanwhile, the S&P 500 had 15 down days in October, representing the highest number of losing days for the index since October of 2008. Both it and the NASDAQ were officially in correction territory for part of this month, meaning down more than 10% from their peak highs. Obviously, it hasn't been all bad news, though, for the stock market. All 3 major indices have managed to set new record highs twice so far this year. In fact, that's partly why the volatility has been so extreme. Consider, for example, that on October 3rd, the Dow was on the verge of breaking yet another psychological milestone in surpassing 27,000 for the first time in its history. Well, it fell short. And within a week, it would experience that historic single-day plunge and then fall by more than 600 points one day later. All of this has been a far cry from last year, when the market set records for low volatility. The VIX, again the volatility index, hit an all-time low of 9.14 last November and dropped more than 17% over the year. So, if the VIX is truly a fear index, that begs the question, what are investors so afraid of this year? Well, we've been talking about those fear factors quite a bit on recent shows. Big investors have expressed some worry over a variety of issues, most notably the direction of interest rates, the Fed's pace on normalizing monetary policy, and especially the economic impact of the Trump administration's new tariffs, aka the trade war with China. What's interesting, however, is that 2017 also had its fair share of economic and geopolitical uncertainties, yet the stock market was consistently able to shrug those off. They simply didn't register on the fear index. So again, that begs a new question. What's changed between this year and last year? Why does Wall Street seem to have lost its ability to ignore these potential threats? Well, the answer might just have something to do with the point that I've been making ever since quantitative easing and artificial stimuli became the Federal Reserve's preferred approach to economic policy. And that is that somehow, at some point, the markets have to make fundamental sense again. After years of being driven mainly by artificial influences, the markets need to realign with economic realities, similar to an addict getting a drug out of his system so he can function normally again. The fact is, I believe the ability of artificial influences to allow Wall Street to completely ignore brewing storms and warning signs is diminishing, and it's diminishing rapidly. In fact, it might soon be gone for a long time. That's why the record volatility we're seeing this year, I believe, is a potential warning sign, a warning sign that everyday investors shouldn't ignore. Could it lead to the third major market correction of this century? And if so, how might that happen? And what might it look like? We'll be back in just a bit to talk about this, but right now it's time to welcome our first guest, Peter Morici, professor of international business at the University of Maryland and one of the country's leading experts on economic policy and international economics. He's lectured at more than 100 institutions, including Columbia University, the Harvard Business School, and Oxford University. And of course, we're always proud and happy to have him back with us here on The Income Generation. Peter, welcome back to the show.
Nice to be with you.
So, okay, help me out with this here. All of a sudden on the news over the last week or so, we're hearing about the markets are nervous because of a recession, possible pullback in the economy, but yet when we were growing at 2%, we didn't hear about that. And now that we saw 4% GDP growth and 3.5% GDP growth in 2 consecutive quarters, now everybody's worried about a recession. What's going on? Why is that?
Well, a couple of things you need to remember is the Democrats put out a lot of good disinformation during the campaign and even last summer, that this is a sugar high, that it can't be sustained, that that's just a brief spurt of demand from consumers having more money in their paycheck. There seems to be complete denial that it'll do anything for business spending, when indeed it has. So that's a problem. The second thing is the stock market isn't overvalued on average, but it's the old story of 1 foot in fire and 1 foot in ice, and on average I feel fine.
That's right.
I mean, the FANG stocks and a few other techs have done really, really well until the last month, but we're starting to hit a realization that several of these stocks have got real problems. Apple has no one left to sell these to. It's got every one of these in the hands of everybody who can afford to spend $1,000 that doesn't, prefer Droid's operating system overall. And so, it's now resorting to raising the price of a $600 phone, $150 at starter phone. It's absurd. Mm-hmm. Netflix, you have to see how they book their production costs. It kind of reminds me of the Krispy Kreme scandal several years ago, where they were booking franchise fees in one-time franchise fees in this year's revenue, not recognizing that it would go away next year, that it was a one-time thing. Instead, over there, they're not really booking their production costs. They're saying these shows are going to have residual value. That might have worked for CBS when they sold them for reruns, but who's Netscape going to sell their reruns to? Last I heard that was Netscape.
Right.
And so if you go down the list, you start to see problems here and there. With Amazon and Google, it's the problem of antitrust. And also, Amazon doesn't make a lot of money selling stuff. They make a lot of money with their cloud services and so forth. Mm-hmm. That is not an infinite market. So my feeling is that a lot of these techs are not the growth stocks that they have been presented us to be. And the market is looking for new sources of leadership. Well, it's certainly not going to come from IBM, Sears, and General Electric. And so without those sources of leadership, and they're out there, but we haven't identified them yet, it makes the markets skittish. So you have all those kinds of things mixing around. And then, of course, you got the Chinese slow growth. And everybody, even people who grow tomatoes, are blaming the steel tariff for their troubles. Well, it's absurd.
So it sounds like to some extent the problem is we're getting defanged. And since some of the FANG stocks have led the market on the upswing, it's no surprise that what you're describing now is causing a pullback. But does that mean in your mind that, and I know you're not a stock picker per se, you're an economist, but in the minute or so we have left in this segment, tell us, does that mean in your opinion that you think finally maybe value will come back? You know, growth has been beating value in the stock market for 8 years. So maybe are we going to get back to basics a little bit now when it comes to stock picking? Is that your best guess?
Well, value, yes, but the question is who has value? We've written the internet out to its logical extremes, and the next 20 years is going to be defined by artificial intelligence. But who are the big artificial intelligence companies? Who are the companies that can monetize artificial intelligence? We know that IBM is big on artificial intelligence, but they don't know how to monetize it. The question is, who is going to monetize artificial intelligence? Is it going to be somebody like Waymo, which belongs to Google, or is it going to be someone else? We don't know. It's where we were with automobiles at the turn of the in the early 20th century, when we had 8 or 10 manufacturers and no one had yet emerged.
So it sounds like what you're saying is you think the answer is yes, except that value is likely to get redefined, is what you're saying. So we need to leave it there for this segment. We need to take a commercial break. Peter, stay with us. And you stay with us too. We'll be right back here with more from Dave Scranton and Peter Morici on the income generation. We'll be right back.
Read David J. Scranton's groundbreaking new book, Return on Principle, 7 Core Values to Help Protect Your Money in Good Times and Bad. Discover practical solutions to the financial challenges facing today's generation of retirees and near retirees. Learn the truth about Wall Street, the financial media, and the secrets they try to hide from everyday investors. This isn't just another book about investing. Working Americans who have lived through 2 major stock market crashes and the worst financial crisis since the Great Depression in the past 16 years don't need another book about investing. David Scranton's approach to financial planning is a holistic system designed for maximum protection, strategic growth, and reliable income regardless of market conditions. Stop planning for retirement with your fingers crossed. Read Return on Principle, 7 Core Values to Help Protect Your Money in Good Times and Bad. Available now.
David J. Scranton, Amazon bestselling author, money manager, and national TV host, is on a mission to educate baby boomers about the need to shift from growth to income. If you're at or near retirement, focusing on income over growth can make all the difference in the quality of your retirement. Each week, David educates America on his Newsmax TV show, The Income Generation, where he provides special reports and more to teach baby boomers about the income model.
Call now for a free copy of David's latest book. Go to soundincomestrategies.com/income to find out more.
Going to be one of the watershed days in financial markets history.
It was a manic Monday in the financial markets. The Dow tumbled more than 500 points after 2 pillars of the street.
Hard to believe it's only been 10 years since the stock market collapse that ushered in the financial crisis. Although warning signs existed about the subprime mortgage crisis that triggered the crash, many everyday investors still managed to get caught in the downdraft. For buy and hold investors still struggling to recover from the 2000 to 2002 market crash, this was their second devastating loss in less than a decade. Could they suffer a third if indeed all the volatility you've experienced this year leads to another sustained market correction? Well, certainly no one has a crystal ball. And some analysts remain optimistic that another correction can be avoided. But many others agree that conditions are indeed right for the next major drop, and have put forth a variety of different scenarios for how it might occur. For example, forecaster Ted Knight recently outlined the following possibility. First, we'll have a period of relief from all the October volatility, which is basically what we're seeing now. There were no huge surprises with the midterm elections, so the markets were recently able to again reclaim some of their lost ground. Next, doubt will start creeping in as the month rolls on and volatility will return. By early December, things will stabilize once more, and a lot of pundits will proclaim the worst is over and start talking about the market hitting new peaks in 2019. Then, just when all seems calm and the fear index is back in the teens, that's when one of the many worries plaguing Wall Street will give way to outright panic, and the massive sell-off will begin. Again, this is just one proposed theory. Other analysts don't foresee the plunge taking hold until later next year or even later beyond that, and some predict it won't happen at all. But for those who do see it coming, all agree that the potential current threats to market stability are very real, very significant, and not likely to just magically disappear into thin air. Recently, the Motley Fool identified 10 factors most likely to trigger the next market crash, several of which we've mentioned already. Number one, the Fed gets too aggressive. This has been a concern all year to the extent that the president has openly criticized the Fed for moving too fast in its effort to raise short-term interest rates. Actually, one of my personal favorites. Number two, according to Motley Fool, a disruption in the oil market. Though it hasn't been in the headlines a lot lately, you may recall that oil prices and production were a major concern for the stock market only 2 short years ago. To a large extent, though, really, that hasn't changed. Number three, a subprime auto loan crisis. Despite lessons supposedly learned, many lenders haven't abandoned some of the practices that helped trigger the financial crisis, particularly in the auto sales industry. Number four, results of the recent midterm elections. With the Democrats winning back control of the House, some of the president's economic plans and policies could now be in jeopardy. Number five, the trade dispute with China, now officially called a trade war by many. Most agree this is the issue that has the biggest potential to trigger the next market plunge. Number six, the market somehow gets defanged. FANG is the acronym, of course, for Facebook, Apple, Amazon, Netflix, and Google, whose collective success have accounted for a major portion of the S&P 500's gains in recent years. As you just heard, this is Peter Morici's favorite. 7, a computer glitch. Since the vast majority of trading volume comes from quantitative-based computer trading, a major network glitch, or a hack even, or some kind of thing like that could be absolutely disastrous. Number 8, a tweet from our President Donald Trump. Some of his Twitter outbursts have already riled the markets from time to time. It's a genuine possibility that one could serve as a tipping point. Number 9, GDP growth falters. It topped 4% in the second quarter, over 3% in the third. Many experts still maintain that the level of growth is a sugar high from the president's tax cuts and therefore unsustainable. And 10, last but not least, another European crisis. Though we're 5 years past the sovereign debt crisis, you have Greece, Italy, Spain, another bunch of European countries are still in debt, and a new crisis overseas could easily trigger the next one here, such as what we've seen in the past week with concerns about Brexit. You'll notice that list doesn't even include things like inflation or the ballooning federal deficit, all other major worries that have weighed on Wall Street this year. What everyday investors need to understand, I believe, is that all of these potential points exist at some time when I believe that history says we're already overdue for a major market plunge, even steeper, possibly steeper than the last two. We'll talk more about that in just a bit, but now it's time to welcome back Peter Morici. Now, Peter, we were talking right before the break about how value might get redefined. So traditionally, you think of value stocks as things like perhaps utilities or some consumer durables, or maybe things that are temporarily out of favor. But what you're alluding to is that there's going to be a whole new generation of so-called value plays out there based upon artificial intelligence.
That's absolutely right. Artificial intelligence isn't going to be a robot knocking on your door that tells you, I'm going to take your job. But rather, it's going to be devices and software that assist you in doing your job more efficiently. It's Watson helping the neurologist or the oncologist diagnose 8 tough cases in a day instead of 4. It's the program that permits Peter Morici to have a student assistant to answer questions by phone that's not really alive. It's those kinds of things, but finding them is hard. Traditional sources of value are getting destroyed. They're not just running themselves to ground, they're getting destroyed. For example, somebody like Amazon is destroying the value at Procter & Gamble.
Sure.
Procter & Gamble is a low-key version of General Electric. There is nothing intrinsic about the overhead charged by corporate at Procter & Gamble, about the headquarters in Cincinnati, that makes all those various brands that it has accumulated over time, many of them by acquisition, more valuable. The marketing techniques that it had, the consumer testing techniques that it had, have been overcome by marketing analytics and by Amazon's ability to put all kinds of generic products on a platform that frankly beat the heck out of Tide, or at least not beat it in terms of its washing ability, but beat it in terms of being able to do your wash for less money.
Right.
And that happens over and over again. After all, what is Gillette going to do to sell you another razor? How many different ways are they going to make that head wiggle, and how many more blades are they going to put on? That's going on. Now, it doesn't mean that value is not out there, but it's much like the eclipse of the agricultural era, and in some ways the eclipse of a lot of mass production manufacturing. The margins in manufacturing are extraordinarily thin. That's why General Motors is worth so little relative to some other companies. But we don't know where they are yet. And after all, how many people successfully picked out Google, Amazon, and Apple when they were cheap?
Right, so the question becomes, if you really want to invest for value, you really want to invest in high dividend type holdings that are out of favor, you have to make sure that you're in commodities that probably won't get Amazoned, is what it sounds like for the most part. Peter, we need to take another commercial break, but when we come back
to that sort of thing.
When we come back from our commercial break, Peter, I'm going to ask you about the trade war, which you alluded to a few minutes ago, and I'm also going to ask you about taxes. You mentioned the Democrats at the beginning of our interview, and I'm curious to see if you think that maybe phase 2 of Trump's tax plan is actually going to be able to get through now that the Democrats haven't taken the House. So stay with us. We'll be right back with more from Peter Morici.
David J. Scranton, Amazon bestselling author, money manager, and national TV host, is on a mission to educate baby boomers about the need to shift from growth to income. If you're at or near retirement, focusing on income over growth can make all the difference in the quality of your retirement. Each week, David educates America on his Newsmax TV show, The Income Generation, where he provides special reports and more to teach baby boomers about the income model.
Call now for a free copy of David's latest book. Go to soundincomestrategies.com/income to find out more.
Read David J. Scranton's groundbreaking new book, Return on Principle, 7 Core Values to Help Protect Your Money in Good Times and Bad. Discover practical solutions to the financial challenges facing today's generation of retirees and near retirees. David Scranton's approach to financial planning is a holistic system designed for maximum protection, strategic growth, and reliable income regardless of market conditions. Available now.
For all the volatility and current market data suggesting that another major stock market crash is coming at some point, there's another compelling piece of evidence that most analysts don't talk about. If you're a regular viewer, you probably already know that I'm referring to the evidence of stock market history. I became a firm believer in long-term secular market cycles more than 20 years ago when I began conducting my own independent market research. I was motivated then by the disturbing levels of volatility that the market experienced leading up to the bursting of the dot-com bubble and therefore the 2000 through 2002 market crash. At the time, as a younger advisor than I am today, I was following the basic Wall Street business model used by most fellow advisors, a model still used today by, again, most fellow advisors, despite the lessons of market history. But those lessons are precisely what motivated me to change my business model. They taught me that the first crash in 2000 was only the start of a new secular bear market cycle that would include a total of 3 major corrections or more and lead to zero net market growth, most likely over a period of about 20 years or so. I believe we're still in that cycle and therefore destined for another major drop, one which history says has to be somewhere between 40 and 70%. That's why I also believe it's extremely important for everyday investors to be aware of market history and how it may relate to all the volatility that Wall Street's experienced so far this year. So here's a refresher. Most people have probably been told that the stock market averages about 9% return per year over the very, very long run. Now, the way that actually breaks down is on average 2 to 3% or so come from dividends, while 6 to 7% comes from capital appreciation or growth. Meaning that 6 to 7% is really an average growth rate over a very, very long period. Now, what most people don't realize is how that average is defined. The way that 6 to 7% breaks down is that there are huge periods of time when the market experiences extreme volatility, but the net result is zero growth. Then there are huge periods of time when the market does very well, averaging double-digit returns per year. Now factor 0 for periods against double-digit return for periods, and that's where you get to that 6 to 7% average. These long-term alternating periods of growth and stagnation, if you look back in history, turn out to be remarkably consistent. The periods of growth are long-term secular bull market cycles, while the periods of zero growth are long-term secular bear market cycles. These cycles date back to the very beginning of the stock market. For example, and this isn't the very beginning, but just going back to 1899, and yes, I meant to say 1899, through 1921, the market experienced tons of volatility, big gains, big drops, but in the end, all the good and bad years washed each other out, resulting in a period of zero growth for 22 years. That was then followed by an 8-year stretch in which the market delivered well over 10% average growth. This was during the roaring 20s, of course. Well, as you know from your history books, that also ended abruptly with the historic stock market crash of 1929 that ushered in the Great Depression. Then from 1929 to 1954, the market again experienced tons of volatility. Big gains, major drops ultimately washed each other out, resulting in, this time, a 25-year period of zero growth coupled with a lot of volatility. Then the next bull market came in from 1954 to 1966. The market did really well for 12 years. But then, as right on schedule, the next secular bear market cycle arrived. In 1966, the Dow hit 1,000 points. And in 1982, 16 years later, guess what? It was back at 1,000. So again, this time, we had 16 years of a bear market. It's the shortest we've ever had in history. Then, as everyone knows, the market took off again, and we enjoyed the best bull market in U.S. history for 18 years, from 1982 through the year 2000. In that time, the market went from 1,000 to almost 12,000 points. That's a 12-fold increase in 18 years. That, of course, all ended with the bursting of the dot-com bubble and the start of the new long-term secular bear market cycle. The cycle that I believe, although many analysts would disagree, I believe that we're still in it today. And as I've explained before, every long-term secular bear market cycle has several things in common, one being that each experiences at least 3 major market corrections that wipe out all of the previous gains. In this cycle so far, we've only had 2. And I believe that, if not for the unprecedented levels of artificial manipulation that the Federal Reserve engaged in after the last correction, we might have already seen that 3rd market drop. But regardless of that manipulation, history strongly indicates that before this secular bear cycle can be over, the market must once again drop below the levels that had attained the high levels in 2000, 2007, and 2013. In other words, the Federal Reserve can delay the inevitable, but it can't deny the inevitable. And today, mathematically, that means that we need to have a drop once again, somewhere in the range of 40 to 70%. Again, is it possible that the more optimistic analysts are right in that all the Federal Reserve's manipulation has changed the course of market history and prevented the next major market drop? Of course it's possible. Hindsight will tell us what happens. But in light of all the current data and lessons of market history, investors within 10 years of retirement need to ask themselves 2 important questions. Is it possible that this is the first time in the history of our U.S. stock market that everything's going to be different? And number 2, maybe even more importantly, is do I really want to take the risk? And what does it mean for me? Now it's time to welcome back for one final block, Peter Morici. Peter, I know you've been a big fan of phase one of the Trump tax cuts. We were able to get over 4% GDP growth one quarter, 3.5% the next. Is that going to be able to continue, in your opinion, for a while? And also, the Democrats taking over the House. What does that mean for phase two of the Trump tax cuts that was on the horizon?
Well, let's start with the second part. There is going to be no phase two. The Democrats are interested in raising taxes, not lowering them.
I was afraid you might say that.
But regard to the continuation of the growth, it's likely to continue through next year. We can continue adding about 200,000 jobs a month by getting people off the bench. That is, people who left the labor market coming back for about 12 more months. After that, we're limited by the intrinsic rate of growth in the adult population, which was determined by who had babies 18 years ago. And that's about 0.5% a year. That's about 65,000 new workers a month, depending on the participation rate. So in order to continue growing, I'd say about 3% next year and the following year, we are likely going to need about 2.5% productivity growth. We haven't had sustained periods of 2.5% for a long time. But in this year, we've had 3% over the first 3 quarters. Amazing.
Right.
The question is, how much of that is because of something fundamentally new, like the invention of the railroad, mass production, artificial intelligence? You know, artificial intelligence is popping up everywhere.
Right. If
you go to the Giant here, that's the grocery store in Washington, you find that there are still 12 checkout ladies, running stuff through, but there's also 12 checkout kiosks where you just scan the stuff yourself and one person supervising them. That's artificial intelligence.
Sure.
And that doesn't make that one person 12 times as productive, because people are kind of slow at it, but it makes it 6 times as productive.
So I get that.
How much of that is out there?
It's the increase in technological advances, efficiency that are going to help us move forward. But so let's change subject one more time. We have about 1 minute left in this block, and we have to say goodbye. In the last minute, tell us, trade war. Can we win the trade war if we don't get a truce here?
We're not going to get a truce very likely, but you're really asking me what's inside of Donald Trump and Mr. Z's heads. I mean, they're certainly no closer on the issues, but the trade war really hasn't kicked in. The yuan is depreciated more than 7%, so it's wiped out most of the effect of the 10% tariff on most of the products. And a lot of companies are blaming the tariff for all kinds of problems, and the Wall Street Journal is very good at writing up anecdotal examples. But the trade data overall shows very little impact from the tariff yet. Except in the 25% sectors of steel. I mean, the 25% tariff on Chinese automobiles. Who buys Chinese automobiles in the United States? I don't.
Sure. Doesn't affect us.
I don't think you do either, and I guess I'll give you $100 if you can find one.
So I guess we got to wait and see what ends up panning out. Hopefully, we can get some kind of truce, or we can get the upper hand here. Peter, thanks so much for being on the show. We've got to leave it there for now. It's great having you once again, and you stay with us. We'll be right back here on The Income Generation. I'm David Scranton.
What is that? Oh my God, it's getting louder. Ah! It's getting louder!
You know, it might be funny when a young man's car is making a weird noise, but it's not so funny when it's your mother's. As we all know, usually when your car is making a noise, it's a warning sign. It means something's broken or in the process of breaking. When that happens, you basically have 2 choices. You can ignore the noise and hope it isn't anything serious that leads to the car breaking down, or you can take the car to a mechanic and have a professional diagnose and fix the problem before it gets worse. By the same token, extreme stock market volatility can very often be a warning sign. And while there isn't anything you can do to fix whatever might be wrong with the market, you can take steps to protect yourself from the risk that it poses to you personally. Again, especially if it's your mom's car. Again, it was extreme volatility in the late 90s, along with a lot of irrational exuberance on Wall Street, that motivated me to start doing my own market research. Basically, I took it upon myself to try to diagnose the weird noise that I heard the markets making at that time, because as professional financial advisor, I knew I was uniquely qualified to do so. More importantly, I felt I was obligated to do so on behalf of my clients. Maybe I couldn't do anything to prevent the impending breakdown I realized was coming, meaning that first major market crash from 2000 to 2002. But I could do something to help protect my clients from the potential damage it would do to their investment accounts. So that's exactly what I did. By changing my business model to one specializing in alternative financial strategies focused on protection and income. That decision remains the one that I'm most proud of in my entire career. And it's been the basis of my continuous business growth ever since. Market volatility is all fun and games, but again, it's not so fun when it's your mom's money. And people tell me all the time, invest my money as if it's your mom's. You know, it's funny because as this long-term secular bear market cycle has gone on, more and more baby boomers have discovered that investing for income can protect them from market volatility as well as the dangers of the next major drop, all while generating reliable retirement income at competitive interest rates and providing opportunities for organic growth through strategic reinvestment of interest and dividends. My goal right now is to help more people make that discovery before it's too late. As I explained on last week's show, now is actually, I believe, an ideal time to lower your market risk, to make the shift to income-based strategies. Why? Because the warning signs are still just that, warning signs. The car's making the noise, it hasn't broken down yet. The market overall is still down less than 10% from its peak. So you can still come out ahead if you reduce your risk now. That could change quickly, though, if any of these bad case scenarios we discussed on today's show actually pan out. So getting back to the car analogy, ask yourself this question. Even if your car stopped making that weird noise, if this were your mom and it stopped making the noise, wouldn't you still want to get it checked out for her before she took a long trip to see the grandchildren, just to be safe? In my experience, most people would, because they know the downside of not taking that precaution greatly outweighs the upside. As that relates to your portfolio, just keep in mind you'll never take a longer trip than that trip into and through retirement. So why not take it with the peace of mind that you really deserve to have? Now it's time to welcome our next guest, Greg Melia. Greg Melia is the CEO of Melia Advisory Group in Tulsa, Oklahoma. He's been in the financial industry since 1989 using conservative income-based strategies to help people in and near retirement protect their savings and achieve their financial goals. He shares his insights on Fox Business News and other financial media outlets, and we're happy to have him back on the Income Generation. Greg, good to have you back on the show.
Thanks for having me, David.
And of course, you and I are, of course, really good friends. I don't know if our audience really appreciates the extent to which that's true. So we talk about financial stuff all the time and brainstorm together. But what's been going on over the last couple weeks, the last maybe 4 weeks? It's weird. We get to, all of a sudden, we get good economic news for 2 quarters in a row, and now the markets are concerned about a pullback. They're concerned about a recession. Whereas when we had 2% growth, nobody talked about a recession. What's going on?
Well, I think it's a combination of a couple things. I think everybody's a little bit worried about the tariff war that's engaging, that's just now really kicking off or becoming implemented. And then, of course, with the rising interest rates is creating a fear that that's going to cause a business shutdown. Between the two of them, I think we're seeing a lot of volatility as a result, a lot of fear.
What do you think about the Fed? Do you think the Fed might just raise rates too fast and create the next recession?
Oh, definitely. The Fed has always been, in my opinion, one of the worst predictors or the worst economic gauges is what they use, is proven to be. A lot of people blame them for the 1931 crash, that they were tightening rates into a... In fact, some people make that comparison today, that they're tightening rates into a weaker economy than they really understand and caused the Great Depression, or part of it at least.
Yeah, no, it's true. And now I see them trying to raise rates again quickly, and we'll see what happens. That's my biggest concern, is the Fed creating the next recession. So stay with us, Greg. We have another segment. We want to have you back here. And you stay with us, too. We'll be right back with more from Greg Melia on the Income Generation. Welcome back to Income Generation. You're here with David Scranton. I'm here with my good friend and financial advisor extraordinaire, Greg Melia from Tulsa, Oklahoma. Greg, you know, it's funny, when the markets were going up in August and September, hitting or flirting with new record highs, you know, every week, you know, it seemed like the markets weren't worried. And now all of a sudden there seems to be this worry. I find, though, in talking to clients every day, and I want to see if this is what you're finding too, that people seem to be worried even when things were calm in the financial markets. Your average investors seem to be worried. Were you seeing the same thing, or is it just here on the East Coast?
No, I would say we probably would see it more here in the Midwest because, you know, the common consensus, things can't keep going up. You know, they know that at some point that things are going to go down, and they also distinctly remember 2008, and they don't want to be this much closer to retirement, want to have that happen to them again. So you see the worry factor, I call the pucker factor, is increasing substantially.
Now, I don't want to pick on anybody who's watching the show, because if you watch the show, you're watching because, you know, God knows it's not because I'm so incredibly entertaining. You're watching the show because you want to stay informed and up to date, and right here is where you can do it on the Income Generation, as we like to say. But that having been said, you know, sometimes isn't it true, Greg, that the more informed a person is, the more they read, the more they watch, oftentimes they're really absorbing more of what I call the dribble, Wall Street's dribble, the stuff that Wall Street really wants them to hear, which is a lot of pro-market language. So sometimes it's the more knowledgeable you are, the more informed you are, the more studious you are, sometimes the more you're blind to the common sense side of it. I mean, do you see that, or is that just me?
I do see that at some level. I also see the other side, that a lot of times what makes news is bad news, you know, and so sometimes people and they start looking, you know, if they're fearful, they tend to start looking for the bad to support their position, kind of a human nature thing, I think, to do. And so I see it work both ways. But you are right. There's a lot of cheerleading goes out there for the market, too. And if you're looking for that, you know, you're going to find it for sure.
So what do you tell people today? First of all, if they're, lack of a better way to put it, hell-bent on staying in the stock market, what do you tell them in terms of their stock market strategy? What should they do? What shouldn't they do?
Well, you know, it depends, of course, where they're at. If they're closing on retirement and they're in a growth strategy, then, which is what you're referring to as being a stock market, then I've got great concerns for a significant drop in the market. You know, we often, you and I talk about a third drop that we think eventually is going to be imminent. But I look at that and think you just don't have the time to recover. You know, what happens if it does drop 50%?
So first of all, maybe you shouldn't have a lot of your money in the market if you're retired or within 10 years of retirement. But if you're hell-bent on staying in the market and you're going to be there, it sounds like you agree with me. Have one finger on the trigger and be cautious. Greg, thank you. It's been my pleasure once again. Time flies when you're having fun. Look forward to having you back. You stay with us too. We'll be right back here with more on the Income Generation. I'd like to thank both of our guests for joining us for another episode of the Income Generation. I'd also like to thank you, our new and returning viewers. No one can predict the future with 100% certainty, and yet there are a number of professions where attempting to do so is an essential part of their job. The main goal of a weatherman, for example, is to try to accurately tell you what the weather will be like tomorrow and the day after that, as far ahead as possible. He isn't always right, but if he makes a forecast for bad weather based upon a preponderance of evidence, most rational people take precautions just in case. Sometimes different weathermen will have drastically different forecasts, one predicting sprinkles, another predicting downpours for the same day. When that happens, it's up to you to examine things like the data they're using and their individual track records for accuracy, and to decide if, you know, for yourself, if you should prepare or just feel confident. All of this is true to a large extent when it comes to another profession that requires attempting to predict the future, and that is financial services. The job of every good financial advisor is to try to help you make smart decisions today, based to a large degree on his expert analysis about what's going on today and then what's going to happen tomorrow. Different advisors, of course, will have different forecasts. It's up to you to examine all the data and the advisors themselves and decide how or if you should prepare. I've shared some of my own data on today's show, as well as a bit about our own track record for accuracy. I'm a strong believer in the compelling lessons of market history, and that belief has formed a strong foundation for my client success over the years. To summarize, I firmly believe that the record market volatility we've been seeing this year is part of a preponderance of evidence indicating that history will repeat itself once again, and that the third major stock market correction of what I believe is our current long-term secular bear market cycle is imminent. If that forecast is accurate, investors over the age of 50, members of the income generation, who haven't made the shift from growth to income and protection, might just get caught in the next downdraft, a drop that history suggests needs to be somewhere between 40 and 70%. So ask yourself, is that risk worth taking, even if a milder forecast ends up proving to be accurate? Ask yourself what you have to gain by not reducing your risk compared to what you have to lose if things go wrong. Ask yourself if it doesn't make sense to prepare for the possibility of a downpour, even if there's only a slight chance it'll sprinkle. Thanks for watching. If you're close to retirement and you really want to know how to protect and maximize your money, yes, it's absolutely essential you stay informed and up to date. And right here is where you can do it on the Income Generation. I'm David Scranton. Thanks again, and we'll see you next week.